Hi there, it's Monica, your big sister in the market. Most people look at the chart and see just numbers, but price isn't pure mathematics. It's a visualization of collective decisions, emotions, and crowd psychology. Every candlestick is a battle between fear and greed, and every impulse is the reaction of thousands of traders and investors trying to take money from each other in the moment. Watch until the end, and I'll explain why a chart should be read as a story of emotions and not just set of numbers. On my channel, I show how to connect technical analysis with an understanding of crowd psychology to see the real reasons behind price movements. You'll find market overviews, trade breakdowns, key level markings, and liquidity zone analysis. The link is in the description, so join in. The chart reflects collective decisions. Price doesn't move on its own, it's pushed by the actions of participants. Some buy because they believe in growth, some sell out of fear of losing, or others lock in profits. These decisions leave a collective trace on the chart. We see how the crowd reacts to news, levels, and past price movements. If price suddenly rises, it means that most people decided to buy in that moment, but behind that almost always lies an emotion, fear of missing out or greed to jump on the train. Crowd movement and liquidity grabs. The market always moves toward liquidity, areas where other people's orders are placed. The crowd often sets stop losses in the same obvious places, above local highs and below local lows. Big players see these clusters of stop and can deliberately push price there to collect liquidity, executing their large orders at the expense of other people's losses. That's why before a reversal, price often makes a sharp spike beyond a level, sweeps the stops, and only then moves in the opposite direction. This isn't random, it's a crowd reaction predictable for those who know how to read this. Panic and euphoria are visible in volume. When the market crashes, trading volume rises. That's panic. Participants are dumping assets en masse. When the market rallies for a long time, there's also a spike in volume. That's euphoria. Everyone is afraid of missing out and jumps in even if it's too late. In both cases, big capital takes advantage. In panic it buys, in euphoria it sells. A volume chart is the thermometer of crowd emotions. Impulses and corrections as the crowd's breathing. No trend moves in a straight line. The market always alternates between sharp impulses and pullbacks. An impulse is the moment when the crowd acts in one direction. A correction is when some participants lock profits while others enter against the move. These phases create waves, and if you see the emotions in them, for example, greed in the impulse and fear in the correction, you understand what is happening in the market right now. So why numbers without psychology mean nothing? Yes, a chart is price over time, but if you look at it as a dry data, you see only the form, not the content. Pure math won't tell you whether a rally is driven by news or crashed by forced liquidations. To trade consciously, you need to see who's driving the market now, a panicked crowd or a big player taking liquidity. Then you'll read the chart not as a picture but as a living chronicle of emotions. In my private Telegram channel, I break down market situations in detail, where big players use crowd emotions and show how to profit from them. No fluff, only real examples and proven methods. The link is in the description, so join now! So, the chart is a mirror of the crowd. Every move, every candlestick shadow, every volume spike, it's someone's emotion embodied in a trade. The market runs not on numbers, but on fear, greed, excitement, and hope. Learn to see the emotion behind price, and you'll stop guessing and start truly understand what is happening. Subscribe to my YouTube. Every week I break down charts and explain how to read their language so you can stay one step ahead of the crowd. See you in the next one!